This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you in part by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
All-time high, the S&P 500 closes at a record. The NASDAQ climbs to a 13-year high. But for investors, what does the road ahead look like as the focus now returns to earnings and fundamentals?
China reacts. The day after Washington struck a deal, our biggest creditor made it clear it isn't happy. But is there any chance China will fall out of love with U.S. treasuries?
And gaga for Google, a big beat for one of the most widely held stocks, sends shares to a new high after hours. And we found the one thing in the earnings report that every investor needs to know about. All that and more tonight on Nightly Business Report for Thursday, October 17th.
Good evening, everyone. Washington was open and back to business today, and Wall Street celebrated big time. The S&P 500 closed at a new all-time high. The NASDAQ is now sitting at a fresh 13-year high. And there were more milestones. The Dow Transports, the small-cap Russell 2000, and the S&P 400 mid-cap indexes all ending at record closes. With the budget and debt ceiling deals wrapped up, investors focused on fundamentals. A rush of corporate earnings, some better than others, along with stronger than expected manufacturing data from the Philadelphia Federal Reserve Bank. We'll have more on those earnings in just a few minutes. But first, here are the closing numbers. The Dow was the only index in the red. It lost 2 points, dragged down by disappointing earnings from three components: IBM, United Healthcare, and Goldman Sachs. The NASDAQ rose 23. The S&P added 11 points to 1733. That's its new record close.
And so, was yesterday's deal in Washington an all clear for the markets or something far, far less? Joining us now to discuss the way forward for investors like you is Nick Colas. He's Chief Market Strategist at Convergix. You know, Nick, I've been calling this the sort of resolution rally that we've been in for the most part over the past week and continuing to today, when you had 23 of the 30 Dow components actually higher, and those three that Susie just mentioned, the reason why it was down. So do you think this resolution rally can continue? Do you think the markets are going to end the year higher than they are today? And if so, why or why not?
Yes, absolutely. And you're right to call it a resolution rally. It was a very nice liftoff after we got the good news yesterday. What's even more remarkable, though, is that stocks really didn't sell off very much during all the turmoil in Washington. They accurately forecast that we were going to get a resolution, and this rally today is really a follow-through. Looking forward, I'm very optimistic about stocks for the balance of the year. We do have several things in our favor. Corporate earnings are still quite strong, even though revenue growth isn't really where we want it to be yet. And at the same time, we still have very low interest rates, and we have hopefully a recovering consumer and economy now that this turmoil has passed.
But you know, Nick, you mentioned about earnings. A number of analysts are saying that for this upcoming current quarter, there are going to be a lot of blame put on this government shutdown. So what's the spillover effect going into 2014, and what does this mean for stocks?
Yeah, there's a very interesting intersection going forward as we look into January, when the next version of the current crisis is going to play over again. The critical junction is going to be Christmas and holiday season in 2013. The consumer was a bit shaken by what happened in Washington, and confidence fell. Now we need to see a resurgence of consumer confidence going into holiday season. That's really the make or break issue for the markets going into the first quarter of next year.
Yeah, I heard someone today describe the market this year as basically a Teflon market. Nothing seems to derail it. What could?
What is really the critical junction here is that even though earnings have been quite strong, we're going to see record earnings on the S&P to match these record levels that we saw today as we see the third quarter reported. However, the revenue growth has been quite sluggish, really flat over the last 4 quarters, no better than 1 or 2%. To really get markets enthusiastic about 2014, we need to see revenue growth begin to pick up, and that's really 100% on the come. It's been a real faith trade so far. We're going to have to see that faith translate into actual numbers come Q4.
So, Nick, you mentioned that we're going to be back into this crisis mode in a few more months. So what should investors do? Do they need like a two-phase investment strategy, pre-crisis investing and then post-crisis investing over the next 6 months?
You know, investors are still, as I talk to institutional clients of Convergex, still very scarred by the events of 2007 and 2008. No one is really taking as much risk as they did 4 or 5 or 6 years ago. And that to some degree is healthy. It allows us to live through this turmoil because investors aren't as much over their skis as they used to be. So as long as you maintain a reasonably diversified portfolio and don't invest too aggressively, you can live through these little mini crises. We saw that happen just in the past couple of weeks when investors continue to put money to work. We should still see that again in Q1 because now we kind of know the playbook. Let's
say I want to put a little bit of money at work. I got some cash on the sidelines. What 2 sectors in the U.S. market would you favor over, let's say, the next 3 to 5 months?
Yes, the 2 sectors we really like the most. One, financials. Financials have been a real leadership group. These are banks and credit card companies, organizations that lend to consumers. Those should continue to do better as the economy improves and interest rates stay low. The second group, which is a little more controversial, is consumer stocks. We talked about how consumers have been a little shaken by what's happened. Holiday season should now have very low expectations that consumer stocks can begin to beat.
All right, Nick, thank you very much. Appreciate you being with us. Nick Colas, Chief Market Strategist at Convergex.
All right, so we've been talking about earnings. Let's get more on the latest earnings. The biggest drag on the Dow today, tech bellwether IBM. It actually beat earnings estimates after the bell last night, as we reported, but the company reported lower revenue, hurt by weaker computer hardware sales. So shares fell nearly 6.5% today after an analyst downgrade and a handful of lowered price targets on the stock. The big worry here, the company's growth strategy, as it focuses more on software and cloud services.
And the second biggest decliner in the blue chip Dow today, United Healthcare. Profits rose 1% last quarter after enrollment shot up by 275,000. But the company warned of higher operating costs in its private Medicare business, which will hurt its full-year earnings forecast, and shares of the nation's largest health insurer were down 5% today.
Now, another blow to the Dow today, Goldman Sachs. Shares fell 2.5% in its first time reporting as a Dow component. And now the investment bank is slashing expenses. Mary Thompson reports.
Some may call it the curse of the Dow, others just a bad quarter. That's how Goldman Sachs CFO Harvey Schwartz described the performance of the bank's fixed income trading unit, known as FIC.
Clearly, not a good quarter for FIC. The significant decline in revenues was driven in part by seasonally slower activity levels seen across the industry and a more challenging macro environment.
The unit's revenue plunged 44% from last year's third quarter, a big reason Goldman's total revenue missed estimates by almost $700 million. A miss analyst Roger Freeman is taking in stride.
These things happen. Not even Goldman Sachs outperforms every quarter.
Goldman's earnings beat estimates in the quarter, coming in at $2.88 a share, as the company slashed operating expenses by 25%. Still, the revenue miss and poor fixed income performance pressuring Goldman's stock, prompting some to speculate this comes with being one of the Dow's 3 newest members. An honor some note quickly becomes a curse. Since 2004, the 9 new members replacing others in the Dow fell 6.1% on average in the first month and 10.4% in their first year in the index. We don't know if a similar fate will befall Goldman, but portfolio manager Anton Schutz sees the third quarter as a minor blip in Goldman's performance. Because Goldman's clients are talking about doing deals, he sees promise in its future.
I think the pipeline is robust, so I think it's a go-forward-looking situation.
A rare revenue miss puts Goldman in an unfamiliar situation, one it hopes to change this quarter. For Nightly Business Report, I'm Mary Thompson.
And one bright spot among the Dow stocks today was Verizon, the co-owner and soon-to-be sole owner of the largest U.S. wireless carrier, said its third quarter profits were up 40% compared with a year ago. Sales rose more than 4% to $30.3 billion. The wireless unit fueled the results as customers paid more for their mobile phone plans. Shares of Verizon up 3.5% today.
And reporting after the closing bell tonight, Google, the search giant, reported better than expected results of $10.74 a share, and profits shot up 36% to just under $3 billion. That's after raising rates for advertisements on smartphones and other mobile devices. But the news wasn't all good. Losses at its Motorola mobile phone unit totaled $248 million. Joining us now from the NASDAQ exchange, Sheila Dharmarajan. Sheila, Google's numbers were obviously strong, as we just reported, but shares are much higher in late trading. What's the one takeaway you see from this report?
Yeah, the one takeaway that investors are really getting from Google is if there was any concern about the company slowing down or maybe becoming a little bit more of a mature tech company, pretty much gone after this very solid third quarter. So you mentioned profits up 36%, but let's take a look at sales because that was a huge beat as well. Up 12% to $14.9 billion. And also paid clicks, that's a metric that the Street looks at very closely, up 26%. So all around a very solid quarter from the company. The one other chink in the report was that cost per click was down about 8%. That's a trend we have been seeing over the past several quarters. But again, big picture, more and more people are connecting to Google. They're connecting to the advertising engine online. All really good news for the company and its growth engine going forward.
And we'll see how the stock does tomorrow. Thanks so much, Sheila.
All right, still ahead, our biggest creditor is not happy about the debt deal, but is there any chance that China will fall out of love with U.S. treasuries? First, a look at how the international markets closed today. Well, the barriers came down at federal memorials, monuments, national parks, and hundreds of thousands of furloughed federal workers headed back to their jobs today. That, of course, is because the partial government shutdown ended after 16 days. Employees who were furloughed or worked without pay throughout the shutdown will get all their back pay in their next paychecks.
And here's something else that we'll be seeing. Now that the government is open, lots of reports on the economy. Perhaps the most important one is the monthly jobs report. You'll remember that the September jobs report was never released as scheduled on October 4th because of the shutdown. But now that Washington is open, the Labor Department announced that it'll release last month's payroll report on Tuesday, October 22nd. So better late than never.
And just hours after signing into law the bill that temporarily ended the budget standoff, the debt limit crisis, President Obama spoke at the White House today, and he took congressional Republicans to task for shutting down the government and bringing the nation, in his words, to the brink of default.
The American people are completely fed up with Washington. At a moment when our economic recovery demands more jobs, more momentum, we've got yet another self-inflicted crisis that set our economy back.
And just today, J.P. Morgan said the impact of the shutdown and debt ceiling battle will reduce real GDP growth in the current quarter by a 0.5 percentage point. Projected economic growth is now forecast to be about 2% in the fourth quarter. The good news, the bank does predict a slightly higher increase in growth in the first quarter of next year.
During the battle in Washington to fund the government before it was partially shut down, there was a lot of talk about efforts to get a clean CR, a congressional resolution or funding bill without any earmarks, no strings attached. But it didn't quite work out that way in the end. Eamon Javers has the details.
New Jersey Senator Frank Lautenberg was a multi-millionaire when he died earlier this year. Still, the Senate decided to squeeze in a provision to the debt ceiling bill, granting his family a $174,000 benefit. That wasn't the only unusual item in the bill. Tucked into the fine print was $450 million for flood relief in Colorado. And there was a $2.4 billion grant to the Veterans Administration to help handle a massive claims backlog. But by far, the most controversial provision is one critics are already calling the Kentucky Kickback, a dam project on the Ohio River that benefits Illinois and Kentucky, which just happens to be the home state of Senate Republican leader Mitch McConnell, who negotiated the last-minute deal, although there's been some dispute about who actually tucked the dam provision into the bill.
This is just going to feed voter cynicism about the whole process, if that is even possible, to make it even worse.
Critics hate these side deals.
When it's snuck in something like this, it makes me just cringe. Why do it? It leaves a bad taste in your mouth.
But some argue that those special projects dreamed up here in the halls of Congress are actually the grease that makes legislative deal-making possible. And of course, all those people who benefit from the spending, well, they always think it's a good idea.
And in the meantime, taxpayers near the Ohio River will have a brand new water project to admire at a cost of up to $2.9 billion. For Nightly Business Report, I'm Eamon Javers in Washington.
So now that the deadlock in Washington has been broken, but a lot of damage already done, how do average Americans view the temporary deal to fund the government and the performance of our elected leaders. Take a look.
I don't think anything will change when it comes to January. I think they haven't done anything other than just simply delay it again.
We need to boot all of the people out and start over in Washington.
We do more for everybody in the world than any other country, and yet we can't get things, going straight here at home for ourselves.
Well, I'm Canadian, so it's a joke to me. It's really funny to watch it from afar.
It just seems like that our government ought to be able to get along and, resolve these issues, and this infighting it's ridiculous.
I'm fed up, but this is my country, so I just keep hoping that things improve.
And here's what the International Monetary Fund's managing director, Christine Lagarde, had to say about the debt crisis. She welcomed the bill to avert a U.S. debt default, but said the U.S. economy needs more stable, long-term solutions to raising the nation's borrowing limit, not temporary fixes. Lagarde said, quote, "I hope the current situation is bad enough that people realize it cannot continue," end quote.
So what does China, the world's biggest holder of U.S. debt and America's biggest critic, think about the short-term deal that was signed into law last night? As Michelle Caruso-Cabrera tells us, the Chinese are not impressed.
Within hours of President Obama signing the deal into law, a scathing editorial, the second in a week, published by a government-backed news agency in China. It said, quote, "Politicians in Washington had done nothing substantial but postponing once again the final bankruptcy of global confidence in the U.S. financial system."
I think the Chinese are frustrated at the United States. They have a lot invested in the United States.
Nearly $1.3 trillion worth held in the form of U.S. government bonds. China is the largest foreign owner of U.S. government debt, and if those bonds fall in value, China suffers financially. In addition to the negative commentary, a Chinese rating agency, also backed by the government, downgraded U.S. debt today, saying, quote, "The latest raise of the debt ceiling shows the government's incapability in improving its solvency by improving the basic economic and fiscal elements."
They, in 1995, pegged their currency to the dollar, thinking the dollar was a stable anchor. They've now lost faith that the dollar is a stable anchor.
There are fears the Chinese could sell a large number of their U.S. treasuries, which could push U.S. interest rates sharply higher. But those fears are unfounded, says John Rutledge of Rutledge Capital.
If the Chinese sold a lot of it to someone else, it would push the price down. That's not really in anybody's interest.
They also don't have many other choices when it comes to investing their large amounts of money. Other countries just don't have enough debt for the Chinese to buy.
Part of their frustration is that they don't have a real easy alternative strategy for doing well in the world other than holding U.S. financial assets and wanting to collaborate with the United States.
Still, it's clear they are trying to find alternatives.
I've had private conversations with Chinese leaders where our instability in terms of bailouts, QE, the budget deficit is really of grave concern to the Chinese.
Concerns which could impact the U.S. financially. For Nightly Business Report, I'm Michelle Caruso-Cabrera.
So what does all this mean for the U.S. economy? Joining us now with his analysis, Simon Johnson. He's former chief economist at the International Monetary Fund and currently a professor of economics at MIT. Simon, so good to see you again.
Thanks for having me.
So, Simon, you heard what President Obama said just a moment ago on our program, that this whole crisis set our economy back. Do you agree with that? And if so, what's it going to take? How long is it going to take for the economy to bounce back?
Well, unfortunately, I agree completely. The amount of uncertainty that was created will turn out to depress growth, reduce job creation, not just this quarter, but I fear also for the first quarter of next year.
So, Simon, let me talk a little bit about the international response that Michelle Caruso-Cabrera was just talking about, China being one, but only one player in the world of international finance. Last night, Mohamed El-Arian of PIMCO said that if we keep doing this kind of lurching from crisis to crisis, eventually other countries, other players are going to build pipes around us. Do you agree with that?
Well, I certainly agree with Mohammed that investors around the world are looking with some shock and horror at our political behavior over the past week or so. And it is absolutely in the interest of China to develop a large, robust offshore renminbi market. And the British this week came out and said they'd be happy to help the Chinese do that in London. So to be sure, we should expect people to diversify away from the dollar, in part because we have demonstrated repeated irresponsibility and given every indication that we're going to go even further in a crazy direction early next year.
Well, our economy, our businesses depend on the mighty American dollar. What are you saying exactly for the future?
Well, obviously, in the short term, the dollar remains the primary reserve currency and an outstanding safe haven, believe it or not, around the world. The question is, what happens 1, 2, 5 years down the road? How quickly can portfolios shift? How fast does the euro rebound or the renminbi rise as a viable alternative to the dollar? The pressure is there. We should recognize that we have no birthright that says the dollar is #1 currency forever. We built up that reputation, good reputation, for over a long period of time, 200 years, I would argue, and we've squandered it over what? 2, 3, 5 years? It's really appalling.
You know, as we look now back on this debt crisis, going up against the debt ceiling for the now second time in little more than 2 years, I wonder if you feel that at some point, if we run headlong once again towards this cliff, that at some point we're going to slip and actually go through that debt ceiling and have, either in technical terms or real terms, a default. Do you think that's going to happen?
Yes, absolutely. Look, the games that have been played are playing with fire. It's extremely dangerous. You don't want to pretend or say or even perhaps mean to go up to a debt default situation or go beyond that and see what happens. That is not how reasonable countries behave. And if we continue to have this kind of absolutely pointless confrontation over the debt ceiling, for example, but also the government shutdown. What did that accomplish? Nothing except make us look unstable in the eyes of our own consumers, our own investors, and of course everyone around the world.
Simon, here's another what-if question. During this whole crisis, there were a lot of warnings that the U.S. economy could slip into recession. What about now? Are we still at risk of a recession, or are we in the clear?
Well, I don't think this is going to precipitate a recession, but for sure we lose perhaps half a percentage point of growth in the fourth quarter. I would worry much more about the beginning of next year. If we have a confrontation in January, February, March, or all of the above, that will really hurt us. And depending on what's going on around the world, I would not be optimistic about our growth prospects.
All right, sorry to leave it on such a downbeat note, but we have to leave it there. Thank you so much, Simon. Simon Johnson, professor of economics at MIT. And coming up, Chipotle Mexican Grill soaring this year, and its profits are heating up. We'll have details next. But first, how commodities, treasuries, and currencies performed today. Federal prosecutors are closer to an agreement with hedge fund billionaire Stephen A. Cohen and his SAC Capital advisors on charges of insider trading. The proposed deal, which could be wrapped up by the end of the month, involves paying a penalty of at least $1 billion to settle a criminal complaint. But prosecutors will give the firm credit after it already agreed to pay more than $600 million to settle similar civil charges earlier this year. Tyler?
And we begin Market Focus tonight with a company that's heating up after the close, Chipotle Mexican Grill. The food chain reporting a rise in profit driven by higher customer traffic. That always helps. That higher traffic offset rising food costs. Now, the restaurant expects full-year same-store sales to rise in the mid-single-digit range. That's slightly above its prior view, and the stock took off after the close, finishing the regular session only fractionally higher at 439.07. But you see that jump after 4 p.m. Eastern. SuperValue supermarket chain reported earnings that beat Wall Street estimates. The company sold more than half of its stores earlier this year, which helped lower operating costs, improve performance. Profits came in 2 cents higher than expectations. The chain's revenue also beat forecasts. Despite the good news, the stock did close down almost 4% to $8.07.
Shares of Select Comfort tumbled after the company reported earnings that were well below estimates. The mattress maker blamed higher costs and weak demand. It also cut its full-year outlook because of the uncertain economy. The stock fell 21.5% to $18.99. It also sent its competitors lower. Tempur Sealy shares closed almost 3% lower, and shares of mattress firm down 4%. And Amarin losing more than half of its value after an FDA panel voted against expanded use of one of its key drugs. The committee said that a study should be completed on the drug's ability to benefit the heart. The FDA is not bound by a panel recommendation and a decision is scheduled for late December. The stock plummeted 61% to $2 a share. And finally tonight, how would you like to own a piece of your own pro athlete? Well, a company called Fantex is launching an all-new marketplace that allows sports fans the chance to bet on the money-making potential and value of professional athletes. The company filed papers today to begin selling stock to the public in Houston. Texans running back Arian Foster proposing that investors are really buying a stake in his future income. So here's how it's supposed to work. Fantex pays Foster $10 million in return for 20% of his remaining contract with the NFL, any endorsement deals and other future income tied to his football career. Fantex is negotiating similar deals with other superstar athletes, but won't say who they are. Are you a buyer?
I'm not. I don't think I would invest when someone's ACL ligament or maybe something nasty could happen to this guy. I would not do that. Maybe I'd short it.
That's Nightly Business Report for tonight. I'm Susie Garrow. Thanks for watching.
And I'm Tyler Mathisen. Have a great evening, everybody. We'll hope to see you back here tomorrow night.
Nightly Business Report has been brought to you by
TheStreet.com, interactive financial multimedia tools for an ever-changing financial world. Our dividend stock advisor guides and helps generate income during a period of low interest rates. We are TheStreet.com.
I'm Susie Garrow with a Nightly Business Report news brief. Washington was open and back to business today, and Wall Street celebrated big time. The S&P 500 closed at a record high, the Nasdaq to a fresh 13-year high, and the Dow Transports, the small-cap Russell 2000, and the S&P 400 mid-cap indexes all ended at record closes. As for the Dow, it erased a triple-digit loss on disappointing earnings from IBM, United Healthcare, and Goldman Sachs, but ending just 2 points lower on the day. The Nasdaq was up 23, the S&P added 11 points. And profits at Google shot up 36% last quarter thanks to more advertising clicks, even though ad rates were lower than last year. Be sure to tune in to Nightly Business Report right here on your public television station.